Demand deposit. A demand deposit account (DDA) is a bank account from which deposit funds can be withdrawn at any time without advance notice. DDA account can pay interest on the deposit funds but are not required to. Checking account and saving account are common type of DDA. How demand deposit work? If depositors were required to notify their banks in advance before withdrawing funds, it would be quite a challenge to obtain cash or make mundane transactions. Demand deposit accounts are intended to provide ready money, the funds people need to make a purchase or pay bills. The account's holdings can be accessed at any time without prior notice to the institution. The account holder simply walks up to the teller or the ATM or increasingly cash online and withdraws the sum they need. As long as the account has that amount, the institution has to give it to them. The money is available on demand, hence the name demand deposit for this sort of account. Demand deposit accounts, which typically are offered by banks and credit unions, are in contrast to investment accounts offered by brokerage and financial services firms. While the funds may be invested in highly liquid assets, the account holder still must notify the institution that they wish to withdraw money. Depending on the asset in question, it may take a day or two for the investment to be sold and the cash to be available. DDA can also mean direct debit authorization, which is a withdrawal from an account for purchasing a good or service. It's what happens when you use a debit card, but it's fundamentally the same concept. The money is immediately available, drawn on the linked account for your use. Special consideration. Demand deposit account (DDA) may have joint owners. Both owners must sign when opening the account, but only one owner must sign when closing the account. Either owner may deposit or withdraw funds and sign check without permission from the other owner. Some banks create minimum balances for demand deposit account. Account filing below the minimum value typically are assessed a fee each time the balance drops below the required value. However, many banks now offer no monthly fees and no minimum balances. Types of demand deposit account. DDA are primarily checking account, but they can include saving account as well. Money market account (MMA) are a bit of a gray area. Some financial authorities classify them as DDA, some don't. Demand deposit make up most of a particular measure of the money supply, M1. This is the sum of all of a nation's demand deposit plus all the currency in circulation. It's a measure of the most liquid types of money in the money supply. As of May 2022, the total amount of demand deposit account in the U.S. officially, the total demand deposit component of M1 was $4.98 trillion. This compares to $1.4 trillion 5 years ago and $733 billion 10 years ago. Requirements for demand deposit. The key requirements of DDA are no limitation on withdrawals or transfer, no set maturity or lockup periods, funds accessible on demand, and no eligibility requirement. The payment of interest and the amount of interest on the DDA are up to the individual institution. Once upon a time, banks could not pay interest on certain demand deposit accounts. For example, the Federal Reserve Board's Regulation Q, enacted in 1933, specifically prohibited banks from paying interest on checking account deposit. Many banks got around that rule via negotiable order of withdrawal account, checking account with a temporary holding period on funds, which allowed them to actually pay some interest. Reg Q was repealed in 2011. Still, DDA tend to pay relatively low interest rate, no interest at all, with checking account Reg Q repeal notwithstanding. They may also charge various fees for handling the account. Demand deposit versus term deposit. A demand deposit account and term deposit account are both types of financial accounts offered by banks and credit unions, but they differ in terms of accessibility or liquidity and in the amount of interest that can be earned on the deposit funds. Basically, a DDA allows funds to be accessed anytime, while a term deposit account, also known as a time deposit account, restricts access to funds for a predetermined period. Thank you.